Welcome. Today we're breaking down two really interesting swing trading strategies, and these come straight from an experienced trader's playbook. So if you're looking for some new ways to look at the market's rhythm, you are definitely in the right place. And that's really the big promise, isn't it? Clarity. The first strategy we're going to unpack is all about spotting these setups where your entire plan, your entry, your exit, your risk is all crystal clear before you even think about placing a trade. Let's see how it works. Okay, so let's dive right in. Now, before we get to the really clever stuff, we have to get our heads around the fundamental building block for all of this. And it's a super simple three-candle pattern that you see on pretty much any price chart out there. Yep, it's really that straightforward. A swing high is basically just a peak, where that middle candle is the highest point, and a swing low is a valley, where the middle candle marks the absolute lowest point. It's just a basic 1, 2, 3 rhythm of how price moves. The crazy thing is, once you start looking for these simple patterns, you see them absolutely everywhere. I mean, just look at this chart. Every single peak and valley, marked 1, 2, 3, that's one of these swings. They literally form the entire structure of how the market moves. So how do we actually use this? Well, our first strategy is all about turning an imperfect version of that simple pattern into a really powerful trading opportunity. This is where we go from just seeing a pattern to having a clear plan of attack. Exactly. The perfect textbook pattern has candles 1 and 3 at about the same level. But what happens when things get, well, messy? What happens when that third candle just doesn't quite manage to pull its own weight? Here is a perfect example in the chart. You can see the swing low, right? But look really closely at candle 3. See how its low is way higher than the low of candle 1? That nice symmetry is broken. Now, you might think this is just a flawed pattern, but actually, this is a huge clue. And this is the key idea. The author gives this specific imperfection a name: unfinished business. You should think of it like a footprint left behind on the chart. It's a hint that the price move wasn't totally complete, that maybe there are still some orders left down at that lower price, just waiting to be filled. And this illustrates the whole idea perfectly. That gap, right? That little area between the lows of candle 1 and 3, it becomes something like a magnetic zone. Why? Well, the market tends to be pretty efficient. It really doesn't like leaving these pockets of unfilled orders just hanging there. The whole theory is that price will often gravitate right back to this level to finish its business before it can really move on. And here's how that clue turns into a solid plan. Your entry is targeting that unfinished area right around the first candle's low. Your stop loss? You tuck it safely just below the absolute bottom of that whole swing, just a pip or two, which is just the tiniest price move possible. And your first target is the most recent high. See? It's a complete, predefined trade where your risk and reward are totally clear from the get-go. Okay, so that's one really powerful way to find trades based on the market's little imperfections. But what if you want to find an entry inside a strong, ongoing trend? For that, let's pull out a second tool for our kit, one that uses a classic, the Fibonacci retracement. Now, this strategy feels a bit more mechanical. First, you spot a strong, obvious move, two clear waves heading in the same direction. Then you slap the Fibonacci tool on there, which is really just a way to measure how far price might pull back before it continues on its way. Think of it like a rubber band stretching out and then snapping back. Now, a lot of traders watch that 50% level, but this strategy looks for a much, much deeper pullback, all the way into the 77% or 88% zone. The whole idea here is that these really deep retracements tend to shake out the weaker traders and can offer these incredible entry points right before the trend kicks back into high gear. All right, before you get too excited and start hunting for these patterns on your own charts, the author gives an absolutely critical warning. And honestly, this is without a doubt the most important part of this entire explainer. And let's be crystal clear, that is not a suggestion. It is a dire warning. The temptation, and believe me, it'll be strong, is to see one of these patterns and just dive right into a trade. But doing that blindly is the absolute fastest way to drain your account. A pattern is just one piece of evidence. It is not the whole strategy itself. So, the real key takeaway is the simple, 3-step mandate. First, you prepare. You ask, what's the bigger trend doing? Is the market even in the right condition for this kind of trade? Second, you have a plan. You know exactly where your entry, your stop, and your target are before you risk a single penny. And then, and only then, as the very last step, you execute. So there you have it. Two very different ways to read the story a chart is telling you. one by finding its imperfections, the other by measuring its trend. Both are powerful lenses to look through, but you have to remember a lens is just a tool. The real question isn't just if you'll see these patterns now, but what other secrets, what other little market rules are just waiting to be discovered, hiding right there in plain sight.